Hello, folks. It's good to see a lot of people attending our webinar today. My name is Naeem Aslam. I'm the Chief Market Analyst at AvaTrade. Welcome to my webinar today. So the topic for our today's webinar is obviously the masterclass that we are going to hold, and it is about how to trade indices. As many of you know, throughout this week, the market has been going through some major turmoil. We have seen massive upward and downward moves in the market, and traders are very much confused about which way the market is really going to swing. So I thought that it would be really good for us to hold a masterclass on this particular topic and then see what exactly and how we can really make a sense of this one, the why it is essential for us to trade indices. So just a little bit about myself. I come with over 10 years of investment banking experience. I've worked with Bank of America as an equity trader. I've worked with Bank of New York Mellon as a hedge fund trader, and hold over 10 years of investment banking experience working as a head of research. And at AvaTrade, I run the research desk. We produce daily analysis on avatrade.com, where I put the fundamental analysis out in the morning, and then followed by that, we have a technical analysis video as well, where we really look into the price action and see what exactly is the derivative for that particular day, and how that is really going to move with any of the events that is going to be happening on that particular day. Now, in relation to questions, I always welcome questions. I always love to see questions coming up from our traders, from our guys, and please feel free to keep asking questions as we go along. But please make sure that the frequency of the same questions are low, so you don't ask me the same questions over and over. I'll try to answer them as we go along, and we will try to cover, because we do have quite a lot of stuff to cover in our today's webinar. Right. So let's begin. Before we do anything else, it is important for me that I go through this important slide, which is risk disclosure, and of course the disclosures and risk warnings, right? You guys can see the second slide, I suppose, that where it says the risk warnings and everything. So anything which will be covered in this particular video cannot be perceived as an advice. If you are seeking for one, please do consult with your own financial advisors, who would be in a much better condition to help you and guide you with respect to that. For the full disclosure and everything else, please feel free to go on to our website and have a look on that as well. Right. I'm just going to quickly look at some of the questions, as if there anything is coming up from that side so far in relation to that, because I just wanted to make sure that you guys are looking at the systems and that you guys have access to everything that I am looking at. Right. Okay. So they're all good so far. So let's begin with our today's agenda and then see what exactly is the agenda. But before we go any further, it is important for me to go through the context details as well. Sorry, give me, I think there's a technicality. Let me just share the screen, because it is saying that it is paused. Why it is paused again? It shouldn't be. Start broadcast. Okay. So can you guys should be able to see my screen once again. Some of the give me once. Right, guys. There is again an issue with this recording. Let me just clean up a little bit. Let me just do it from this way and then see why exactly these technicalities. These technicalities, I just really hate them when they really happen during these webinars, and why it doesn't really let it. It's not. Can you guys see my screen again? Sorry, guys. I don't know. We checked everything. We looked at everything. No, Riverson is saying that no. Why it is doing this? How about okay, here we go. Now, finally, we are back on. Thank you for your patience. I don't know, just the technicalities just really happen. And then sometimes it's just in IT, so apologies. So in order for you guys to follow me daily and on my Twitter, the handle is right in front of you guys. It is Naeem Aslam 23. And our official Twitter handle is at AvaTrade. So I will show you the screens of those ones as well in just a short period of time. But our YouTube video, the channel is AvaTrade, and on our AvaTrade YouTube channel, what we produce on a daily basis are two different kind of videos. Firstly, we look at daily fundamentals. So what are the fundamentals which are going to be we cover on a daily basis? So we talk about that, how they're going to impact the market. We also do that. And then in technical analysis, as I said to you guys earlier, we look at the deep, we perform deep analysis on various different derivatives, and then we look at certain instruments on a daily basis and then see how they are going to move. Now let's move on to the next one. So the agenda for this particular webinar is we're going to look at why one should trade indices, the inverse of indices, the fund flows, defining levels, and defining a strategy. So why do we want to really, why to trade? Why do we really want to trade these indices, right? So let's begin with this. Now let me bring up the Bloomberg Professional, and then let me discuss everything from the price action perspective, right? So let me so to answer the first question, which was the first question was that why do we really trade indices, right? We trade indices because when we look at, forget about this chart first of all, whatever is in front of your screen, just listen to me very carefully. The reason that we trade indices is because when investors do not want to expose themselves to a large number of stocks and they believe that they wanted to have an exposure, they wanted to have an exposure to a large number of stocks and they don't want to have exposure to small number of stocks, that is the specific reason that you would trade indices, because exposing yourself to indices really gives you exposure to all the indices inside that. So what do you have, for example, if you trade DAX, right? So you have all the stocks within that. If you trade Dow Jones 30, you have all the Dow Jones 30 stocks. You have exposure to that. So you are not worried about one particular stock, how that is trading and how that is going to perform. So basically, by trading one instrument, you are trading the entire list of the stocks within that index. Does that make sense for you guys, first of all? Yeah. Okay, great, good to know. So In a market like the we have these days, right, where the market is just really swinging, even today, the market started on a pretty positive note, but over Asia we saw a negative note. So if you are really trading stocks, you are just not going to get that much of a big bang for your money. So it is always good for investors to hedge their risk, because if you are trading Apple, then there are other stocks like Amazon, there are other stocks like Microsoft. If you have one index, if you trade like S&P 500 index, you will have an exposure to the full list of those stocks, and then you will be trading, by trading one particular index, one particular derivative, you'll be trading you will have exposure to all of those stocks. That is one of the key reasons that I really like, right? So this is just the background of why do we really trade indices. Now, in order to look at what indices are the most important ones to look at. Obviously, if we're looking at the US indices, we are talking about the three major indices. We're looking at the S&P 500 index, we look at the Dow Jones, we look at the Nasdaq. If we are over in Europe, we talk about DAX. If we are in the UK, then we talk about FTSE 100, and if we are over in Japan, in Asia, then we look at Shanghai index, we look at the Nikkei index. So again, by trading one particular instrument, which we have it on AvaTrade.com on our platform, you are really trading to the wider range of different assets, right? So it's not that you are trading one stock, but you are trading a large number of stocks, and then you have an exposure to all of that. Now, what I really want you guys to focus on, first of all, is the price action and the price action itself. So the chart which is right in front of you guys right now is the S&P 500 index, right? So this S&P 500 index, let me just make it a little bit bigger over here so that you guys can have a clear look on that. And then remember, towards the end of this webinar, we are gonna give you one particular strategy to take away, to walk away today with that really nice, good strategy. So please stay tuned, stay with me in order to understand that strategy. So what we're looking at right now is the S&P 500 index. So that is the chart right over here, right? So I'm just going to perform the price analysis first of all, and then I'm going to look at the other elements of this particular chart. So just to explain to you guys, the S&P 5 on this particular chart, this is a daily chart. What it shows you three different indices. First of all, in the pink, you have your 50-day moving average. In the green, you have your 100-day moving average, and in yellow, you have your 200-day moving average. Now, for me, obviously, it's the 200-day moving average that I really look at when it comes to the indices. When it comes to any indices, any index, I really look at the 200-day moving average if I do not have a position in any of the index, because I know that this is where the institutions are looking at, and once the price touches that, it is a really great opportunity. But for other investors who like to take some risk, who do not like to wait for that long, because remember, the last time the price dropped below the 200-day moving average was back in June 2019, they can always trade when the price crosses below the 100-day moving average. So when it comes to indices, it is always about three different moving averages, and it is always about buying and selling that index when it crosses above or below that index, above or below that moving average. So in this particular incident, what we're really looking at, the three moving averages, we're looking at the 50, we're looking at 100, we're looking at 200 moving average, right? And after that, what we look at is, okay, what's my risk appetite? If my risk appetite allows me to take more risk, then I'm very happy to take the trade as long as the price crosses below, or let me just highlight that, below this particular moving average, 50-day moving average. But if I do not have that much of a risk appetite, then I'm going to wait for the price to come onto the 100-day moving average. If the price crosses below that, that's a sell signal. If the price comes back above that, that's your buy signal. But as I said, for me, it's the 100-day moving average, the one that I look at the most, because once the price comes and touches it, just like how it did over here, because the price came and it touched it, price came very close over here as well, but didn't touch it. And this is what I am looking at, because I'm a conservative investor, and it doesn't matter if I'm looking at the S&P, whether I'm looking at the DAX. For me, it is pretty much the same. Okay, so that's what I look at. When we look at this particular price action from the start of September last year, we see that the price has been in a pretty much upward trend. And if you are buying it when the price touches the 50-day moving average, you were making pretty good bets. You were very, very happy if you do that. Just to let you know, again, this is the ETF. It's called SPY, which tracks the S&P 500 index, just in case if you're confused about the prices on this side. So I just wanted to ask you guys, are you guys clear about this particular idea of buying and selling on particular moving averages? I'm always using SMA, just to let you know, never EMA, always SMA. Okay, so people are saying they're clear about that. That's really good to know. Okay. Thank you so much for for the compliments. Thank you. Okay, right. So now when I look at the S&P 500 index, the opportunity is there from the perspective of the 100-day moving average, because price has crossed below the 50-day. It didn't stop. So that's your first sell signal. If you wanted to sell it, that's beautiful. And obviously you wanted to buy it when the price crosses above the 100-day moving average, sell it when it crosses below the 150, and buy it when it crosses above the 100. But if you wanted to continue to short, which currently we are in this particular case under this particular strategy, because the price is still trading below the 100-day moving average, then you cover when the price comes close enough to 200-day moving average. But in order for us to buy, if the price crosses above the 100-day moving average, great. And if it not, then if it continues to move to the downside, I'm really going to look at for the price to come to near its 200-day smooth moving average, right? Now, let me just show you something very exciting about this particular index. Now, one may, you guys should ask this question, that Naeem, why are you looking at the ETF, not the index itself? The reason that I am simple or smoother, simple or smoother, it's pretty much the same. Sorry, there was a question over there. The SMA is simple moving average, or people could just say smooth. It's just not much difference, it's the same. So what I was saying was that you can ask the question, the name, why are you looking at the SPY ETF, not the S&P 500 index? The answer to that question is, guys, that I wanted to show you that what is the fund flow. And remember, we have done a lot of videos about the fund flows and about all of this particular idea in our fundamental videos and in our technical videos as well. So we've done all of that. So fund flow, basically what we look at is we look at the daily percentage change, and then in order to measure that, we have to look at it from the ETF perspective, and then we have to, what does that tell me? That tells me whether investors are buying or whether investors are selling from that perspective. So in order to do that, I really have to look at from the ETF, because it gives me the daily breakdown. So when I look at the ETF, I can see that there has been enormous amount of money coming out of the US equity, because you can see that the ETF, sorry, this is not that. Give me one sec. It's right over here. Estimated money flow right over here. So from the last few days, what you can see is that the people have been pulling money, and even as of today, I am still seeing negative flow when it comes to really S&P 500 index. And this particular area right over here is like something that we have not seen all the way going back to this particular point, right? Or even, in fact, if you really wanted to get the exact points of this one, then I have to look at from this perspective. So you can see that the last time that we seen the market becoming so hesitant was when it happened back in September last year. So let me delete this drawing and then let me highlight those areas very clearly for you. So let me bring this again. So once over here, we saw this massive sellout back in September. And then after that, we've seen even bigger sell-off back in September 2018. Right now, we're seeing this sell-off. As of now, the money coming out of the S&P 500 index is only because of that reason. Because what is happening right now is that investors are still taking money out. So as long as investors keep taking money out, you know, basically the trend is really going to continue to the downside. However, speculators are going to look at something else as well, and then they will see it from the perspective of institutional money, or where the institutional money is coming in. And if the institutional money is coming in, then obviously speculators will have no choice but to really follow on with that. But under this particular scenario, what we're really looking at is that the money is still going out. Guys, the reason that I am really giving you all these nuggets, the reason that I'm sharing all this information, as always, is because this is a premium information. And this information is only and only available on Bloomberg Terminal unless you have other very expensive subscription basis. So it is very important for us when we are looking at the indices. First of all, we look at them from the moving average perspective, simple moving average perspective, consisting of 3, 50, 100, and 200. Then we look at the fund flow, and then we see that what exactly that fund flow is really telling us. If the fund flow shows that okay, that in the outflow out of that particular ETF is slowing down, then okay, it makes sense from our perspective, because remember, we were looking at the price. When we were looking at the price, we were looking at from the perspective of 100-day moving average. And in order for us to have that money, to have that bet on the long side or to the upside, we wanted to look at the fund flow, and the fund flow is still showing that the investors are still not very much convinced. So far so good. Does that make sense for you guys? Any questions so far? Any major questions? Okay, great. Okay, all right. Now to the fun part. As always, in all of my webinars, I always promise one particular strategy for you guys, and I wanted to show you that particular strategy from the perspective of back testing. I wanted to show you that how that back testing has performed and how the results were. So get ready, because I am about to bring that up for you guys and then share that with you now. Here we go. Now, this is so interesting, so interesting. Why? Because the opportunity is actually right on your doorstep now. And the reason that it is so interesting, we are not changing anything. And the indicator that I am using for this particular strategy is the normal indicator. This indicator is your Bollinger Band. The basic concept of Bollinger Band is you buy it when the price pierces the downward, the lower band, and then you close the position, your long position, when the price pierces the upward band, and then you reverse your position from that point. And then this is the basically your basic concept. So what I have done under this particular scenario is I have gone back, I've done the back test starting from the 26th of February last year until today, and I put at the S&P 500 index. I said, okay, so give me the results of the S&P 500 index by using the Bollinger Band, and then look what we have. We have 0 losing trades. First of all, on the long side, we made 3 long trades. All of them were 3 winning trades, and all the long trades are shown by these green arrows. And on the short sides, we made 4 short trades. So here we are, 1, 2, 3, and 4. This is just the exit as of today, just showing you that. And then all of them, as you can see, they are all profitable. And then overall P&L for that particular period was well over 15.67%. And for the long side and for the short side, 4.52%. And total PNL is 20.19%. Beat that. That is just amazing, amazing return for the S&P 500 index on the daily time frame by using the Bollinger Band. Now, are you guys clear about this particular strategy? Do you understand what do I mean by this? Yeah. So the questions are coming up. What settings do you use for Bollinger Band? They are just a normal standard Bollinger Band. I am just using 2 standard deviation, right? Bollinger Band upper and lower, and then 20-day moving average. Yes, so they're saying, can you review the use of Bollinger Band again? Yes, okay, so let's do it one more time. You click on long position, either the moment that the price crosses below the lower band of the Bollinger Band, or you can always have that safety net for you, and then you click on the buy position soon the candle crosses above and closes above the lower band of the Bollinger Band. Now you're running that long position, let it run, let it run, let it run. The moment it touches the upper band of the Bollinger Band, you close your position. Yeah, you close your long position. Now you reverse your position to your short position. You continue, you continue, you continue until the price crosses below that moving the lower band of the Bollinger Band. So the moment that it does that, you close your short position, you open it. So once again, you can always have your own safety nets, and then you can always wait for the price to get back into above that above the lower band, lower line of the Bollinger Band, and then trigger the buy trade. Similarly, you can wait for the price to cross below the upper line of the Bollinger Band and then trigger your sell trade. So these are just a confirmation trade for extra comfort for you. Shorter time frames. Let me just review some of the questions again and then see what people are saying. What some of you guys are talking about. Can we use the same strategy for short-term time frames? No, absolutely no. Please, please, please do not do that for different instruments. Do not do them for shorter time frame. The concept is the same, but the thing is that I have done the back test for this particular strategy on this particular time frame on this particular derivative. So do not try it on different derivatives on different time frames, because the results will be very, very different, and you will not have what we have right over here, which is 20% gain over the period of 1 year with 15% winning trades and 4.52% gain on the short side as well. None of the trades were losing trades. All of the 7 trades made were winning trades. So that is the beauty of the current situation. The beauty of the current situation, again, is that the price has pierced the lower line of the Bollinger Band. You can certainly click that buy button if you want to, if it fits your portfolio, or you can wait for the price to go above the lower line of the Bollinger Band and then click the buy button, right? Okay, guys, that's all. That is the strategy that I really kind of wanted to share with you guys, and I wanted to make sure that you guys understand it. I wanted to make sure that you guys understand the indices. So just to review everything once again, the reason that we trade, the reason we use we use indices is primarily to get exposure to a large number of stocks, because it's good from hedging perspective. Second is we look at the price action from the moving averages, simple moving average perspective, 50, 100, and 200. And then we talked about the fund flow, where we looked at the S&P 500 index, where what we decided, or what it was clear to us, was that investors are still pulling money out of the S&P 500 index. And then finally, I gave you a strategy to trade an index, which is your Bollinger Band with your standard, with your standard, with your standard. 3 times I've used this term, with standard, all the definitions, all the measurements, all the settings. So 20-day moving average and 2 standard deviation from the top and from the lower side of the Bollinger Band. Try it on a daily time frame for the S&P 500 index. We have done 7 trades by using the back test, and all of them were beautiful and were accurate. And by doing that, we produce a gain of 20% on this particular portfolio. Okay, thank you so much. See you guys next week.